welcome to the final trading day of July right here in Lagos, Nigeria. We see the markets are open right now at trading. And if July wasn't so good for you, or maybe good for you at this point, because the NGX has been bullish, all through. But let's see what August, has in store. But let's get to the top stories that set your agenda now. Let's see what's playing out with oil. Oil prices, they eased a bit today, but still up about 1.01%. And finally, we have both benchmarks there above $70 per barrel. Not so convincing for WTI, so that's still ranging at this point. But Brent crude, that's $73.24 a barrel, big 1.01% uptick there. We see investors are weighing the risk of supply shortages amid U.S. President Donald Trump's push for a swift resolution to the war in Ukraine through more tariffs. Though a surprise build in U.S. crude stockpiles, that weighed on prices, so that could have been higher if not for that. So that's what's playing out right there in the oil market. We'll keep tracking to see how it plays for the rest of the day. And it's still a lot of talk around the oil market. To see the Dangote Refinery there, they dismissed reports of a planned shutdown in December, calling the move illogical, due to expected high petrol demand. In June, the refinery's 250,000 barrels per day RFCC unit had a planned maintenance, but this was cancelled after emergency repairs were done in May. With crude deliveries now averaging 605,000 barrels per day, analysts say any disruption could benefit European petrol traders, struggling with oversupply. So we see Dangote Refinery there denying rumors of shutting down refinery. Well, let's look at some company earnings now. It's still earnings season. It's upon us, and big earnings coming out every day at this point. We see BUA Foods PLC. They announced a stellar performance for the first half of 2025, posting 101% surge in profit before tax, about 276.1 billion, up from 137 billion in the same period last year. The growth was driven by strong revenue gains across all segments, particularly in its newly scaled rice operations, which recorded a staggering 2,923% year-on-year increase, with total revenue rising 36% to 912.5 billion naira, and earnings per share nearly doubling at 14.45 naira. The company has further cemented its leadership in Nigeria's fast-moving consumer goods sector. So there you have it. We see revenue there up 36%. Cost of sales, that's about 26% there. Up. So definitely, not as big as the last time we saw there, where cost of sales was quite big, and when you see cost of sales rising, that means it's getting more expensive to make sales from the company. Now we see gross profit, that's up 55%, profit before tax 101%, and profit after tax there 98.6%. So we'll see how investors react to this performance there on the exchange. That's later today. We'll find out how the stock is trading. All right, so other stories now. We see UAC of Nigeria set to acquire Chi Limited, makers of Chivita and Hollandia from the Coca-Cola company. The deal, pending regulatory approval, will boost UAC's footprint in Nigeria's consumer goods markets. Coca-Cola says the sale aligns with its asset-light strategy, allowing it to focus on top brands. It recently pledged $1 billion investment in Nigeria over 5 years, subject to a stable business climate. UAC's boss, that's Mr. Fola Eshimoju, says the move builds on Chi's strong legacy. Meanwhile, shares of UAC rallied to a 52-week high following that news. Investors always react to big news in these markets. So other stories now. The Attorney General and Minister of Justice, Chief Lateef Fagbemi, says Nigeria's newly signed tax laws are designed to place the country on a firm economic footing. Speaking at an annual workshop on communications sector issues, he described the reforms as timely tools for improving revenue collection and public trust in the tax system. Take a listen.
It is important to also take into consideration the agitations, the misgivings, the concerns that people had expressed before the passage. When these concerns were expressed, the president asked that the critical stakeholders be engaged. They were engaged, and so what we see today is a product of that engagement. and let people see the advantage. That it is not all about the micro aspect. It also deals significantly with the macro, because it is the macro aspect that produces the micro, in the sense that if you look at, oh, we will get money from collecting tax, that is not the main aim. The main aim is to have the economy, trade, and other economic activities well grounded, take its root. It is from taking the root that you can be talking of collection of taxes.
Well, let's head on to the commodities market now. We have Mr. Bismarck Rouhani, he's the MDCO, Financial Derivatives Company. Good morning, sir. Great to have you on the show.
Good morning.
Yeah, so it was
Thank you for having me.
great to have you, sir. So, yes, we finally have the rate decision in the U.S., and I guess no surprises here, or maybe surprise for some people. We know President Trump has been pushing for rate cuts. He met physically with the U.S. Fed chair when they were getting a tour of the building that's for the U.S. Fed there, one of their constructions. And he did say he would like a rate cut, even when he met with the U.S. Fed chair. But it's not happening, at this point. How are you seeing what played out?
Well, thank you very much. Let me say that we call this a dizzying day, because so many things happen on one day. It reminds me of an old movie I watched before called Training Day, where Denzel Washington, in the final act of that movie, he says, "What a day, what a day."
What a day.
So yesterday was what a day. The first time in 32 years where there have been dissenting voices, 2 dissenting voices of the 12 wise men of the Federal Open Market Committee. This is the first time in 32 years that we've had that kind of dissent. 2, the guidance given by Chairman Powell was, well, we do not know. We are governed by the data. He did suggest that the tariff inflation effect will only begin to kick in. It's only at that time you'll be able to say, yes, we will do this maybe in September. The president wants a cut in September. The chairman says, no, let's look out for the data. Also, what the market is saying is that if we're going to have a cut in September, it may not be 25 bips, it may be 50 basis points, which is good. So what that did essentially was to weaken the dollar, make sure, and you announced it just now that the price of oil, Brent, has gone up to $72 plus. This is good because when the dollar weakens, the price of commodities denominated in dollars increase. So we see that, and it's quite interesting that the question is that, what does this mean? The stock market took it, all indices went down, but after hours, we saw Meta, which is Zuckerberg, the earnings blew out the market, and it went up by over 11-12% after hours. Then this morning, Microsoft also had released their results yesterday, and Microsoft now appears to be the second company that will achieve $4 trillion of market capitalization after Nvidia. So a lot of things are happening. And one other thing that happened, which is very significant for us, is that Ghana, for the first time in its history, dropped its interest rates by 300 basis points, 3%. That is huge. So, and it has gone down all the way to 25% from 28%. That's huge, right? So when you take all of this into consideration and take what have you just said now, the Nigerian stock market is on a tear. It's not just it's a runaway rally, but we warn as well that the Nigerian stock market might be overbought, and a correction could happen very swiftly if we're not careful. But all things being equal, we think that one, the Federal Reserve, the maintaining status quo was good for the market. We also know that today is the last day before the tariffs on African countries and all that, August 1st kicks in. So we are watching all of these variables at the same time, but it's very, very interesting day, and that's why I told you that it's a dizzying day, according to The Economist, and I say, what a day.
What a day. Definitely, what a day. And you did mention, history being made there with dissenting voices between the 12 wise men there for the U.S. Fed. So These two Fed governors that wanted a cut, this time, do you think it's from President Trump's influence?
No, I think the way the Fed is selected, the FOMC is selected, these are seasoned economists, and they don't just have a herd instinct. They look at the data, and some of them have the two that Governors Michelle Bowman and Christopher Waller voted for a rate cut, and that's two. And there was one absentee. So 9 over 12 is quite a number, and they are looking at the data, and I don't think it's politically motivated. I think economists are independent thinkers, and definitely they believe that the time is here. Why? Another thing that happened yesterday was that the GDP numbers came out at 3%, which means that the US has avoided a technical recession. Normally, if that is the case, and that the economy is strong in terms of output, then does it need a further impetus to bring down rates at this time when we do not know what the total effect of the tariffs will be on domestic prices? So it is that argument they're having, and I think to us in Nigeria, I think the first thing to note is that we have a favorable balance. That is, the US exports more to us than we import from the US. So on a bilateral basis, Nigeria is not expected to suffer any tariff backlash. Two, Nigeria is, from a geopolitical standpoint, is non-aligned. So Nigeria is not going to get in the crosshairs of anybody as far as the tariff wars and geopolitical movement in Gaza and all those places. So Nigeria is in a good place in terms of maintaining its trajectory. Also, Nigeria, the IMF revised its growth projection for Nigeria and increased it right at this time, and also reaffirmed the fact that we will see inflation begin to moderate later in the year. That is good. And we've seen some movement in the foreign exchange market again, which shows that people are now beginning to go and buy foreign exchange again. And we've seen the gap widen. In fact, the naira depreciated by about 1% to 15.54, and the gap between the official and the parallel market has widened to 20. When we spoke on Tuesday in the studio, the gap was only about 3 naira, which means that people are now beginning to order commodities and import commodities for the Christmas season. In our projection all along, we have said that we expect the naira to trade between 1550 and 1600 in the worst case scenario. But now that the price of oil is up $72 a barrel, it's good for Nigeria. Our production is up, and therefore we think that the depreciation of the naira at this point in time is short-lived, and it's not going to be a runaway situation.
Right. So what do you think happens to the naira, going into next week? And we're seeing some currency plays right now with the negotiations between the US and EU. We did see the euro actually lose ground, against the US dollar on the back of the negotiations there and the deal that was made. So the DXY is also seems to be strengthening at this time. Any risk for the naira with all of that?
No, I think the naira's fundamentals depend on, 1, the price of oil, 2, the price of LNG, and 3, foreign portfolio inflows. So what will happen on the 6th of August, there's going to be a treasury bill auction. If the rates don't go down too sharply, then the foreign portfolio investors who are enjoying the carry trade will remain with us. And that means that the naira will stabilize at current levels. In any case, we believe that the fundamentals are naira friendly at this time. And therefore, even a temporary depreciation of the currency due to external factors, shocks, will not have such a damaging effect on the value of the naira in the foreign exchange market. The naira is fairly priced at this time, and it's well above its purchasing power parity value of about 1,200 naira to a dollar.
All right, so it's definitely earnings season now, and we've had a couple of Nigerian companies report this week. I'm sure you've been going through some of them. Any standouts for you? We've seen consumer goods companies there. Some good reports. So far for HY1.
I saw Cadbury. Cadbury was quite impressive. We've seen BUA Foods. Of course, Dangote Cement have done some wonderful things. So the atmosphere for corporate earnings is very good. One, because sales are up, and that's we must bear that in mind. Costs are down, margins have improved, and more than anything else, these people are making more money because there's stability in the exchange rate, and that means they're not carrying excessive inventory or borrowing from their parent or suppliers, so that has actually mitigated the risk of what you call foreign exchange losses because of they're due to parents and due to suppliers. So with that eliminated more or less, and sales begin to climb, then we think that there is some consistency in the earnings profile of companies. Having said that, don't forget that they had a backlog of losses, right? So they have to claw back those and write off some of it. So the effect on taxable in what we call while the gross profit is high, but taxable income will be low because they have to claw back some of those earlier losses, right? It depends on, that's the accounting treatment, and the accountants will give you a better idea. So 1 minute. So what we're looking at is that there's depreciation of the naira for now, for this temporary period, because of the front load, people buying things for the Christmas season, and the time to open those LCs is now because we're going into August, tomorrow. We're also seeing that cocoa futures are up, but I think, Nadi, let's make a point here. We went on a market survey yesterday and we saw something very interesting. Almost all the commodities we're talking about showed a decline in price. Beans, for example, which has been sticky for a long period, has dropped by about 3% to 82,000 naira. Garri dropped also by 3% to 32,000 naira. Peppers fell all the way by 11% to 80,000 naira. And tomato basket actually fell by 31%. From around 110, 120 to 75,000. Onions crashed all the way to 110,000. What is this telling you? Telling you, one, the harvest is here. Two, that because the exchange rate is stable, export smuggling of commodities across to neighboring countries has reduced. And as a matter of fact, we are beginning to see import smuggling. People are now smuggling yams and commodities from Benin Republic, from Cameroon, back into the Nigerian market. So that confirms to us that we are going to be having some moderation in food inflation, at least for the next 2 months. One interesting thing, though, is that the price of the new yams are falling, but there's a limited amount of use for new yams. What you need is old yams, because you can use that for pounded yam, you can use that for all sorts of cuisine. So you take it, the commodities, the ingredients, pepper, tomatoes, onions have all declined. We've seen the status quo as far as chickens are concerned. Turkey dropped, but generally speaking, there's more food now available in the markets than was there a month ago.
Right, and I did try to buy plantain recently. It was always 5,000 for a bunch, but I think the lady said it was about 4,500 or 4,000. So I guess we're starting to feel that. Hopefully, we have the dirtiest December. When it comes to you did mention that.
We have an interesting dirty December, but before then we will have the October. In the stock market balance, we have what we call the October surprise. So let's wait and see. Never say never. Never say never.
Thank you so much. That's a good place to anchor there. That's Mr. Bismarck Rwani. He's the MDCO, Financial Derivatives Company. Thank you for coming on today, sir.
Thank you for having me.
All right, we'll take a break now. When we come back, we'll talk about credit to the private sector right here. What's happening there? That's in a moment. Just stay with us. So we see small and medium enterprises widely regarded as the backbone of Nigeria's economy, accounting for over 90% of business and contributing significantly to employment and GDP. Yet access to finance remains a persistent hurdle, limiting their potential from high interest rates and collateral requirements to limited financial literacy and weak institutional support. Well, join us now to unpack What to expect in the second half of this 2025, and credit to the private sector and the real sector. We have Dr. Jeku Zomene, the Group Executive at the Alternative Bank, joining me right here in the studio. It's great to have you, sir.
Thank you, Laji.
And I know, for you being in the financial services sector, when you see interest rate decisions, definitely I know you are interested, in that. And we had another hold yesterday by the US Fed. Nigeria here, it's been a hold. But the difference is for Nigeria, it's high. It's high interest rates that we're dealing with at this point. And we're also talking about balancing, giving credits to where credit should go. Private sector, the real sector, help these businesses grow at this time. What are you seeing so far in Nigeria? Do you think we're seeing any improvement, when it comes to, some of these small businesses or the high-risk businesses getting credit?
I think there's been significant improvement. I mean, from a liquidity standpoint and credit provision standpoint. But one of the things, and this discussion often comes up, right? Why are we not providing sufficient credit to the private sector? Why are we not providing sufficient credit to the MSME space and SMEs, etc.? And my response is often this. When we talk about providing credit to this sector, we are looking at our traditional money deposit banks or even the microfinance institutions. But in every economy, there are several financial institutions that play several roles, right? You need to understand, the general populace needs to understand that commercial banks, for instance, are custodians of depositors' funds, right? So essentially, you take money from the surplus in the economy, right, and provide the financing to where there's deficit, and then for those that charge interest, that the interest they charge is the premium you take on the risk you are taking. So it means that if you give me your money to keep, right, you are not interested in me providing that money in a high-risk venture where you lose your deposit, correct?
So, well, yeah. So I don't want to lose my money.
You don't want to lose your money. And in fact, the regulator will not want the bank to lose that money, which is why banks have capital. The capital a bank has is not money the bank lends, no. It's the buffer it keeps for the risk he's taking. So that if he loses your money, right, he can absorb that loss, right? Which is why anytime the regulator is looking at the bank's capital, they say, okay, your capital vis-a-vis the risk you are taking is insufficient, so you need to raise capital. Why am I giving this background? So it means that, to enhance the complexion of risk that financial institutions take, there are certain type of institutions that come to, improve that risk, and then before banks can come in and play, which is where you have institutions like development finance institutions playing a role. In Nigeria, we have several. I think we have about 8. We have the BOI, we have a BUA, there's Bank of Industries, Bank of Agriculture, we have Development Bank of Nigeria, we have Nexim, etc., etc. Those institutions are mandated in all jurisdictions have similar institutions, are mandated to come into that space to help improve, provide the nature of capital that's required to support the entrepreneurs, and then the banks are coming to support. Okay? So has lending improved? Yes, lending has improved, but can it get better? It needs to get much better like day before yesterday.
Because some would argue that, the banks make a lot of money in Nigeria. I've had a conversation recently. She said that she runs a bank in the UK, and she doesn't get the amount of charges she gets from a Nigerian bank. So people believe the Nigerian banks make a lot of money, so they should be able to play around with some, some credit.
In a way, that's like the 6 blind men of Hindustan who went to see an elephant. So they're seeing one part of the elephant.
Right.
But if you consider that in Nigeria, right, first of all, when a bank is lending you money, right, in the sector we have what we call the cash reserve requirements. And today the cash reserve requirement is at 50%, right? 50% is one of the highest, probably the second highest globally. What a 50% cash reserve requirement means essentially is that for all the deposits the bank has, remember I started by saying the bank doesn't lend its capital, right? So it's the deposits that the bank lends. For all the deposits the bank has, the central bank sterilizes 50% of it, and the bank doesn't have access to it. So that money is not available to lend. Now, why will a central bank do that? Why will a Federal Reserve Bank do that? You do that often when you are targeting inflation and when you are targeting exchange rates, right? So what that does is that when you put money into the system, for instance, when the government releases FAC, and you know it's a significant amount of money, you try to mop up a lot of that liquidity, right? So that it's not available to, you know, when you say too much money chasing the hair.
Few goods.
So you mop it up, so it's not available. Now, what that does for the bank is that it significantly increases its cost of doing business. Because some of those deposits, I'm taking it from somebody at a cost, right? And I'm keeping it, and it's unremunerated. So you have different kinds of cash reserve requirements globally. There's a remunerated cash reserve requirement. There's unremunerated cash reserve requirement. There's unremunerated, there's differentiated dynamic cash reserve requirement, and there's unremunerated differentiated dynamic cash reserve requirement. So let me explain.
Huge requirements.
So when I started my banking career in 1998, 1999, the cash reserve requirement was 1%.
1%?
Yeah. I think you moved to 2%.
So if I was depositing money in your bank,
yes,
you just give the CBN 1% of it?
Absolutely. I think you even moved to 2% during the Soludo consolidation era, right? And because banks raised capital, and I think there must have been some concern around the level of liquidity in the system, and so it was increased to 2%. But subsequently, over time, when the regulators started using monetary policy instruments to target inflation and exchange rate stability, it now became this, mopping up this liquidity that banks have. So now, cash reserve requirement cost is just one cost that the Nigerian bank has. In Nigeria, the bank has what we call the AMCON resolution cost, which is a percentage of their assets. We also have, there's another cost that was just recently introduced. It can't come to mind now. But there are several layers of cost, and I suspect in terms of cost that the banks bear, and I'm not saying this
aside from EMTL and all of that.
And I'm not saying this because I work in the industry, right? So I'm saying this almost from an academic standpoint. Those costs, somebody is going to ultimately bear the cost. So while we appreciate what the regulator needs to do, and it's important because if not, we'll have had runaway inflation and exchange rate crisis, but that cost will ultimately be passed on to the borrower, and which is why you have these high interest rates, right? So when you then say the banks are making a lot of money, right, from a returns perspective, the banks are carrying a lot of cost. Even the cost of raising capital, if you have raised capital, a few years ago when I was in the space of capital raising, investors will require an ROE of, say, 17% from their investments in a bank in South Africa, for instance. In Nigeria, it was over 30%. I don't know what it is today. So when you go take investors' money and invest in your bank, you have got to pay the stakeholder his money back now.
So there's a cost at this point. The banks are not suing the money.
When we say the banks are suing the money, I see those numbers. They look interesting, but once you adjust for all these things, you see that relatively they are not making that much money.
All right. So there's this conversation now a lot about faith-based lending, faith-based investments, at this point, and we have a couple of faith-based banks at this point. How is that helping, this situation? Because obviously you're not allowed to charge interest rates. That's as a faith-based platform. Mm-hmm. So how is that growing? How's that helping, credits to the private sector?
Okay, so let me put it this way. I'd taken an early retirement from banking at some point. I just wanted to face my role in the academia and some non-executive roles I had. And then I was invited to join a faith-based bank. And in the course of the conversation, one of the things that had often bothered me while I was actively, doing all the investment bank, commercial bank stuff was, in Nigeria, when you engage your customers, they will often tell you, banks don't want to take risks with me, right? They just want to give me money, and then when there's a problem, they'll run away. And then when I encountered non-interest banking and specifically Islamic finance, and because I currently am a group executive with Alternative Bank, which is a non-interest bank, and I was having a conversation with my friend Abubakar Suleiman, who is the MD of Sterling Bank. And midway into the conversation, I said, I know exactly what you are trying to achieve, right? Because when I left commercial banking, I wanted to focus on impact investments. I wanted to see where, when I make an investment, it changes the lives of people, it creates value in the society and the larger community. And I said, this is impact investment. Essentially, what, when you say faith-based bank don't charge interest, that's not exactly what it is.
It's not a true picture.
No, I mean, on the face of it, that's what it is.
Right.
So in Islamic jurisprudence, there's something that's the fiqh versus the masakid, which is the law versus the higher objective of the law, right? The reason why Islamic finance institutions don't charge interest, because in Sharia jurisprudence, it's perceived as exploitative. You are exploiting the customer, right? So it's not because it's interest in itself. So everything that's exploitative is haram. Just the same when in Islam, alcohol is haram. It's not haram because it's alcohol. If you look at the masakid, it's haram because it intoxicates. So anything that intoxicates is haram. So it means that heroin will be haram, drugs will be haram, etc., etc.
You can't invest in any of that.
You can't invest in any of that. Now, so when you then map Islamic finance against the market and how it's going to impact on the market, I refer to it as a superhero license, right? It's a superhero license in the sense that because Islamic finance has, or non-interest banking has, two broad product groups. There's the trading side and the equity-based side.
Right.
Right.
Well, let me just pause you there. I'm so sorry. I just need to take this quick break. But this conversation is getting really interesting. I know you're heading. When we come back, we'll continue the conversation. That's at the moment. Just stay with us. Welcome back. Well, let's head back to the conversation. And I still have with me Dr. Jeku Ozemenez, a group executive, the Alternative Bank, and we're talking about non-interest finance and credit to the private sector. Thank you so much for staying on, Doctor. And there you were.
Radically change the face of banking, not just in Nigeria, but how it impacts the market and our customers.
Right.
Now, remember earlier I said that there are traditional, conventional banks are not structured to take the kind of risk that some of these SMEs require. But you see, in the non-interest banking space, we have equity-like products where the bank can actually partner with the customer in an investment. So they're investment-type products. So for instance, I have a product where I'll provide financing. If I review your project, I provide financing to you. You act as my agent, and I pay you a commission, right? We have products where, and I'm very particular. I want to explain the product in brass tacks. I don't want to use highfalutin terms that will confuse our audience.
Right.
We have products where we essentially share profits, right? And this is on the equity side. We have lease-type products. Now, on the trading side, when people say, oh, we don't charge interest, and we say, okay, we have a product like our Murabaha product, which is cost plus markup. People, they say, no, but if you're doing markup, that markup is interest, right?
Right.
But it's not. It's radically different, and I'll explain why it's radically different. First of all, remember that it's based on ethics. Non-interest banking is based on ethics. So first of all, the idea is that you are not exploiting the customer. That's one. Second is that when we look at the business and we agree on a markup, that markup is fixed for the entirety of the tenure of that transaction. So it's not like an interest-based relationship where midway MPR changes or something. I'll say, okay, you know what, I need to change my interest rate. No. And even when the contract elapses, I cannot charge you anything above the markup, which is the profit we have agreed are going to share, right? What does that do for the customer or the borrower, or the not borrower in this sense, or the partner? It enables the person plan appropriately because you know the horizon of the profit that's going to be available to be paid to the bank and what you can take. Now, the equity type investments are even much more interesting.
But does this happen with small businesses? Are small businesses able to come to say an alternative bank now and say, okay, I need to do this business. You're going to share profit with me. Is that how it works?
We're not even structured yet. We have not even gotten to the side to play with the big boys because from a capacity standpoint,
right, we
don't even have the capacity to play with the big boys. So this is a growing market. So it's available to every customer, provided, remember that the credit principle still applies.
Right.
The 5 C's of credit. The first C is character. You must show character. In fact, in Islamic finance, the person has to be trustworthy. Remember, this is based on ethics. So we have to review that and ensure that this aligns with this individual. My colleague will say that we should add a 6th C to the 5 C's of credit,
right,
which is consistency. Looking at this individual, you have proven over time that you are consistent, right? You have taken financing from people, you have not failed, you have done things with people, you have been upright, etc., etc. And then it makes it easier because remember, banks do not lend against collateral. Banks are not real estate firms. Collateral is just the comfort they take in case the risk crystallizes. So principally, we are lending against character. Every other thing flows, which is why today, within that consistency, some of us argue that at some point, data will replace collateral.
Data?
Yes, because with data, you have all the information you need to determine whether somebody is consistent or not.
And does that dovetail into open banking? Because there's also conversations around open banking.
It dovetails into open banking. It dovetails into everything you do, whether in the retail space, everything you do. Once you have the data, that gives us an idea of what your habits are, how you behave when it comes to your relationship in business. Then I can literally...
Do you think Nigeria is ready for open banking?
You see, the thing about change is that if you are still dilly-dallying, one day, if you are treading water, you're actually retrogressing. A few years ago in this industry, we had some small banks. We used to call them new generation banks, and people used to refer to them as one-branch banks, right? We had these big behemoth banks where, like, who are these fellows? They will soon fizzle out. A few of them fizzled out, but those that survived are the big banks today. Some of those behemoths that we were talking about back in the day have simply disappeared. So I think open banking is here to stay. With digitalization, open banking is just a matter of time before it happens.
And, definitely talking about change at this point, there's also a lot of conversations around stable coins, blockchain technology, and we're hearing, some banks or like JP Morgan now actually looking into, that side of things. Are Nigerian banks actually exploring, such technology at this time, or are we just saying, you know what, we don't understand it, let's just stay away for now?
Okay, a few years ago, this conversation was a bit esoteric, and everybody was cautious about digital currency, etc. In fact, some people even put digital. I never truly believed in digital currency as it was then being marketed. But I think everything changed for the world with, what's the name of this, Libra, the Facebook currency.
Facebook, right, Libra.
As soon as Facebook launched Libra, all the regulators across the world woke up. I'm not sure people understood the implication of that Facebook's move. When you have a digital currency and you have a platform like Facebook that cuts across jurisdictions, right? One of the things that a government uses to affect fiscal policy is its monetary policy, right? If you have some young chap sitting somewhere, right, who can control your monetary policy from anywhere, right? It means that substance over form you have a new global president, right? Because if I can control your monetary policy, I can actually overthrow your government. I can change market dynamics in your country. I can do anything. And I think that it was a wake-up call for the doubters. And so you then began to see even central banks, sovereigns begin to look at central bank, digital currency, et cetera, et cetera. So that will happen. If that will happen because the world has been shocked into the reality of what can possibly happen if you don't do something, you don't move before them. I know that blockchain technology is going to play a significant role in everything we do. Maybe not as it was initially touted, because when it first came out, it was like
against all the central figures,
yes,
decentralization,
yes,
and all of that.
The technology is there, and because technology is changing. So, I mean, Moore's law says that the level of change in technology is going to be moving, not even in geometric progression, I don't know, exponentially. So it's going to be improving over time, and we're going to see this that has come to stay.
I'm talking about improvement and big changes happening at this time. Who knows? Maybe AI might be a central bank at some point with the way things are going, artificial intelligence everywhere. But who knows? We'll keep watching.
I'm waiting for intelligence augmentation, because I'm tired of having to read things. I want to be able to upload it and have this conversation with you.
Natural
and you think I'm an Einstein.
Yes, exactly. Just put in the AI, install it. Thank you so much. It was great having this conversation with you, Dr. Jeku Zemene is a group executive at the Alternative Bank. Thank you for coming on today.
Thank you.
All right, so definitely it's all about what's playing out in the global space at this point. We've had the latest interest rate decision that's coming out from the U.S., and I guess no surprises there, and maybe some surprise, because we know President Trump has been calling for that rate cut. He's asked for it so many times, and maybe at some point we might get that rate cut this year. I think consensus now, it's one rate cut in 2025, and who knows, maybe it might not even happen. But let's find out what's happening in global space. We have Ini John McCraw with the details now. She's joining us. I call her Ini Pink today.
You're the second person teasing me with this pink. I don't know. But Ladi, I mean, it was mostly as expected, and I know yourself and Mr. Rwani had that extensive conversation on it. But I mean, let's get it from the U.S. perspective.
Exactly. Yeah.
Now, good morning, everyone. Welcome to the global news segment of Business Morning. Federal Reserve, held interest rate as expected. Chair Jerome Powell showing no preference for cutting rates at the central bank's next meeting in September. The comments from the Fed leader after the rate decision hit stocks in afternoon trading, with the Dow Jones we see losing about 172 points. But take note, this is like the first time in a long time we've had dissenting voices. So two of those attending the meeting of the board were not in support of the hold. But let's listen to some of the considerations, according to Jerome Powell, that was considered after this, or for this decision to be reached.
Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%, and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation could be short-lived, reflecting a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to keep longer-term inflation expectations well anchored, and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. For the time being, we're well positioned to learn more about the likely course of the economy and the evolving balance of risks before adjusting our policy stance.
So there you have Jerome Powell saying that perhaps the adjustment may not becoming so soon, considering that we're still waiting for the impact of the tariffs on the economy, according to him. But he did also say that other variables were looking positive. For instance, the jobs market, the unemployment market, the GDP, inflation also tapering. Also, those were looking good. But he believes that the uncertainty is still there, and that's why they have to be very cautious about it. Now, tomorrow is D-Day, yes, from Liberation Day to Reciprocal Day. I don't know if that's what President Trump will want to call October 1st, but it's supposed to be tomorrow. But ahead of that, President Trump has unleashed a series of tariff deals and demands on the eve of the deadline, including surprises on India and copper, as the U.S. president attempts to create a new global trade order. So yesterday, Wednesday, he announced tariff of 15% on imports from South Korea that matched the rate for their neighbor, Japan. And then the U.S. also imposed 25% tariff on goods imported from India, plus an unspecified penalty for buying Russian oil and weapons. We know cheap oil has been coming from Russia to China and India for some time now. Posting on his Truth Social platform, he said that the measures would take effect from the 1st of August, that's tomorrow, and the U.S. deadline for a trade deal. He describes India as a friend whose tariffs are far too high, among the highest in the world. He also criticized India's purchases of Russian military equipment and energy when everyone wants Russia to stop the killing in Ukraine. We see the U.S. also coming heavy on Russia, and I believe that's a major driver of oil prices. This morning we saw it exceeding $73 from about 70 or 71 yesterday. And talking about trade deals, Taiwan says that its negotiators are drafting a joint statement with the U.S. on their bilateral trade deal, appearing to make some long-awaited progress just a day ahead of Donald Trump's tariff deadline. Technical negotiations, they say, have been completed, and both sides have reached a certain degree of consensus on issues including tariffs, non-tariff trade barriers, trade facilitation, supply chain resilience, and economic security. Now, let's put all of this together now and see perhaps what to expect in the U.S. economy. We're going to be having this conversation with Julian. He's a visiting lecturer in economics at McGill University in Montreal, and he's a former special advisor to the Ministry of Finance in Canada. Hi, Julian. Good morning and welcome to the program.
Hi, thank you for having me.
Great. So yesterday was very busy for both President Trump and Jerome Powell, and it seems more countries are getting trade deals. Well, the impacts of it we'll wait to see in the coming days. So we saw Jerome Powell there expressing uncertainty because of these tariffs, but he said it hasn't seeped into the economy yet. The impact has not been felt yet. I wonder what your thoughts are on this.
Well, it takes some time. There are lags before tariffs and retaliatory tariffs and the impact of declining trade affect both the real economy and inflation. Having said that, countries like the EU, Japan, the United States, and China, they're very, very large internal economies, and it's going to take some time before they're such large economies that they're able to adapt. They're more resilient than many economists give them credit for.
But I mean, we heard Jerome Powell say that when you look at the macros for the United States, the job data, the unemployment, the GDP, they're looking good, even inflation. So where do you think we could see this impact of the tariff first, or how soon?
Well, for the United States, I'm here in the United States right now. Just on looking at anecdotal evidence, there seems to be labor shortages. The economy seems to have shrugged off the effects of the trade war. So that in response to the question, when will we see this? I think we will see an increase in the price level, but nowhere near as significant as some of the big economic models were calling for. And also, the end goal of the Trump administration and President Trump himself of this trade war is to repatriate some manufacturing. And they may well achieve at least part of that goal because you see that investment is increasing in the United States.
So when we look at the world, I mean, data and projections seems to be softening. At first, when President Trump started the tariff trade war, there were jitters everywhere, WTO and all. But with all of these trade deals that we see, it seems to be softer than expected. Do you think that the impact, perhaps long term, will be not so bad?
Long term, I don't think the impact will be so bad. We're shifting from an era with this trade war, and it's really been the United States border with the rest of the world has been thickening since 9/11. Now we see a kind of a radical acceleration of this under Trump's second administration. But I do think long term we're moving from an era of deep globalization which benefited some parts of different countries. And we're shifting to a new era where there's going to be more, in each country, there's going to be more domestic production and domestic demand. The transition will be messy for some countries. It will involve slower growth and higher inflation. But for the big economies out there, the United States, China, Japan, Europe, and some other countries, I actually think long term, there may be a long-term boost to both production and employment.
And I think that's one of the plans of President Trump, attract more manufacturers. For instance, the deal he has with the EU, I think is bringing in a couple of millions of euros or dollars in investment into the country. So perhaps that will also help the United States. But I'm just curious, there's no Canada in all of this conversation. What's going on? What have you heard?
Well, I'm from Canada, and I spend a lot of my time analyzing the impact of this trade war on Canada and what the implications are for the Canadian government. And it's strange, we're supposed to have a deal by August 1st between Canada and the United States. And what I think is that probably President Trump and the overall Trump administration are demanding concessions in the form of privileged access to critical minerals, privileged access to water, and they also want a 10 to 15% base tariff. And this may prove, and also there's 50% tariffs on aluminum, steel, and now copper, 25% tariffs on automobiles. So I'm assuming that the Carney government in Canada is fighting tooth and nail to have a better agreement.
All right, thank you so much, Julian, for that. Of course, tomorrow that's August 1st, and we'll see if perhaps anything is happening as we speak, and we could hear about it by tomorrow, before tomorrow. Thank you so much for your thoughts and perspective.
Thank you for having me, Edie.
Great. So, Ladi, well, Nvidia has been given assurances by Washington that it will be allowed to resume exports for its made in China H2, but China is not very happy about that. They summoned them. They have some security breach allegation on them. So we don't know if it's sentimental or factual, but I mean, this is China and the United States, and anything can happen.
I guess the battle continues at this point for technology and for everything.
Yes.
Leadership in this world.
Yeah, and you know that between China and the US, it's just the deadline being pushed to August 12th. Then we'll have to start talking again about the tariff rates and all of that.
Right.
So it's not over yet.
Yeah, I guess another key word for this year, deadlines.
Deadline tariffs.
Deadline.
Exactly.
Tariffs. Thank you so much, Aini, for giving us the details there. Just a quick one of what's playing out to the local bourse right here. That's the stock exchange. We're down by 0.96% right now. That's for live trading, 137,000 points, about 1,340 points wiped out this morning. But we'll find out what plays out at the close of trade today. Thank you for watching. I'm Ladi Williams from the team right here at Channels HQ. It's bye for now.